Hey, it's Jim, and this is FRM Part II, the topic on credit risk measurement and management, and the chapter on credit risk. You're probably thinking, like I am, that we've spent 10 or 12 chapters talking about credit risk, and we're going to spend another 10 or 12 chapters continuing to talk about credit risk. So you might be surprised that this chapter in the very middle is entitled Credit Risk. After all, if you go back to that very first chapter, we were told that the general definition of credit risk is the inability or unwillingness to make timely payments on a loan. So clearly we're well beyond that initial definition. In fact, in the first paragraph in this chapter, we're told that we're defining credit risk in terms of bilaterally cleared derivative transactions. Now, of course, let's go ahead and start with this concept of bilateral clearing. Bilateral agreement just simply means that we have an agreement between two parties to go ahead and exchange some capital. So let's go ahead and pretend that I'm a bank. I'm Jim's bank, and you're some other bank over there. Call it Rock Bank. And I may owe you $20 million, and you may owe me $25 million for some kind of a transaction. And so the easiest thing would be for us just to exchange that $5 million. So a bilateral agreement will go ahead and allow us to net those cash flows. But then go ahead and layer that bilateral agreement with derivative contracts, and imagine the two of us having positions in a futures contract and an option contract and a mortgage-backed security and a synthetic collateralized debt obligation and swap contracts. And so we have all these contracts going back and forth. Some have maturity dates of 5 days. Some have maturity dates and expiration dates of 30 days and 100 days and 6 months and 12 months. Whatever that time period is, we have all these transactions, so we need to have a timeout. Someone needs to say, you know what, enough of all this. Let's make sure that we keep track of all of these transactions. And that's what the clearing does. Now, of course, exchanges, they have this formal system of clearing all of these transactions. But in the customized market, whether it's just the general over-the-counter market or just two financial institutions agreeing to do something over lunch, we need to worry about this credit risk. So we could call it maybe counterparty risk, we could call it third-party risk, we could call it default risk, we could call it credit risk, and all those terms probably apply. So what we're trying to do here is to figure out exactly how to manage and quantify this credit risk. So during this chapter, we're going to have conversations on things like, default probabilities and hazard rates. And we're going to use that Valuation model that we did in a previous reading. And so this is going to be a fun 30 minutes or so. All right, here are the learning objectives. So assess credit risk, that's always a good one. We've done that before, and we won't really have to do much extra work here to make sure we cover that learning objective. But then we'll have conversations on CVAs and DVAs. Now, CVAs, they've been around for a really, really long time. DVAs are a little bit controversial. I'll give you an example here about my father and me here in just a little bit. But there we go, probability of default using credit spreads. We did a little bit of that in a previous chapter. Credit risk mitigants. And then default correlation and the Gaussian Copula model. I think those are probably the two primary, together with CVA and DVA, potential exam questions. And then we'll have one or two final slides on the CreditMetrics approach, which we introduced in a previous chapter. All right, so here we go. Assessing credit risk of derivatives. What does this mean? So bilaterally cleared derivatives, we need to go to this ISDA. They have this master agreement. Sounds like a master plan. You guys ever see that really, really great movie, Master of Disguise? Oh boy, that's 20 years old by now. Anyway, super fun movie. Anyway, we have to abide by this master agreement, which says things like, in a lot of derivative securities, outside of the option world, there is no exchange of capital up front. And so we need to worry about margins. So there's an initial margin posted to probably a third party, and then variation margin. This is kind of marking to market. Maybe we do it daily. We do it daily on the floor of the futures exchange, but maybe we do it weekly. Maybe we do it every other day. Maybe we do it every monthly. But typically, we're going to do this with all of these derivatives, 99% confidence over a 10-day period. And then default is defined as all the ways that you would think default would be defined. Failure in payment, failure in posting margin. How about this one? Failing in posting proper margin or sufficient margin. And then outright bankruptcy. And then there are all sorts of loss scenarios. You can look at those down at the bottom. But essentially, we have the value of our derivative, whatever that thing is, and then we have the value of the collateral. So the derivative, what happens to the derivative price? That goes up depending what's happening in the spot market. And then the value of the collateral, that changes. Now, you might remember that I love to give the example, since one of my favorite movies out there are the Pink Panther movies. If you use the Pink Panther, that diamond, as collateral in one of these transactions, well, that probably doesn't fluctuate very much. But if you use treasury securities as collateral, then that fluctuates. So those loss scenarios depend on the relative value of the initial transaction and the value of the collateral. Let's move on to CVAs and DVAs. And you might remember I told you I'd give you an example about my dad. Now, my dad is no longer with us, but when he was, he loved gardening in his backyard. So let's suppose that my father and I made a bet. So it's April, and my father used to love his tomato plants, and he bought these. He would buy these cherry tomato plants. Some were red, some were yellow, some were orange, and he loved these things. So in April, when he planted one, let's suppose that I noticed that one of these plants was, kind of like the Christmas tree in the old Charlie Brown movies. And I said, you know what, Dad, there's no way that thing is going to produce anything. And I said, you know what, if it produces 50 or more cherries, I'll pay you $100. If it doesn't produce 50, if it produces 50 less, you pay me $100. So the value of our bet in April is we bet $100, but the payoff is not going to be until, when do the cherries ripen? Let's say sometime in July. So let's just suppose that's 3-month time period. Now, look down at the very middle there. There's that FND. So that is the value of our derivative, of our bet, assuming there's not going to be any default. Now, this is not a perfect example, but, I love my dad loves me, so we're good for the bet, right? If the other one wins and loses, we know that there's going to be exchange. Now, that's probably not true risk-free or true no default, but let's just suppose that it is. All right, so what's the present value of that thing today? I don't know, maybe it's $94 or $96. So suppose for some reason my sister comes along and says, you know what, I want to get in on that bet. And so I sell her either the entire amount or partial amount. Let's suppose I sell her the entire amount for $95 or $96. Okay, so now we need to make an adjustment to either her financial position or my dad's financial position. Let's just focus on my sister. So there's going to be a credit value adjustment. And that means what is the present value of the expected cost if my dad defaults on this thing. So what could happen that would cause my dad to default? Well, let's go ahead and say it. The obvious one is that he could pass away. And some other reasons is that he could get sick or, right? There are lots of reasons why he could default on that thing. So that is the expected cost to me or my sister if she buys this thing. But then there's a debit value adjustment. And what this tells us is that there is some benefit to us if we default. So suppose that we default. Suppose that I default. I decide not to pay my dad because of some reason, whatever that reason might be. Maybe something happens that I pass away, or maybe my sister passes away, or some other less extreme example. And so that represents a cost to the counterparty. So that's why down there we have a minus the CVA and then a plus the DVA. And of course, the plus the DVA, this is super controversial. But, the governing bodies, Congress in different countries, here in the United States, they say, you know what? In order for you to record the value of your derivative, you've got to make a credit value adjustment and a debit value adjustment. So in the blue box and in the orange box, those are kind of clear explanations of what's going on. And this is pretty well summarized inside of the chapter. But the whole thing about my dad and his cherry tomato plants might help you to understand that there are benefits and costs associated with this. So look down at the bottom. This is probably a good exam question. CVA is the cost to the bank, and DVA increases the transaction's value. So the question then becomes, how do we go ahead and make these adjustments? Well, as you can imagine, we need some variables. We need this V, look in the gray box there. We need this V sub I, which is the present value of the expected loss to the bank if that counterparty defaults. And then the V star is just the opposite, right? And then the Q, that's this risk neutral probability. And you should know this by now, that going back all the way back to 1952, we assume risk neutrality in lots of finance models, because what we're doing is we're focusing just on that first moment of the distribution. We really don't care about risk. And the reason that we don't care about risk is that, especially in the derivatives market, is that you can arrange these things so that you can form a risk-free portfolio, which brings in that whole concept of arbitrage. So seriously, all we're doing here is we're summing the probabilities times the present value on both sides. Now let's go ahead and calculate the present value of that expected loss. Now you think about it, doing it with my dad and the tomato plants, that's probably fairly easy. We could come up with some numbers, but imagine if we're a financial institution and we have tens or hundreds, gosh, dare I even say thousands of derivative transactions that include all of those examples that I said earlier: synthetic collateralized debt obligations, mortgage-backed securities, futures contracts. And by the way, I just taught my students the other day. We did we went to I think it was ICE who does the temperature futures contracts. And so I was asking my students, why on earth would somebody take a long or a short position in the temperature in Chicago, Illinois? And they scratched their heads. And then after a while, they said, wait a minute. Here are some really good examples. So we have all these crazy and massive derivative positions. How are we going to keep track of? I mean, suppose my dad had a farm and not just one tomato plant, and we were betting on tomatoes and cucumbers and lettuce and carrots and Honeycrisp apples and all that kind of stuff. So what do we need? I mean, I'm leading up to this, and you see it at the top of the slide. Of course, we're going to rely on our old friend, the Monte Carlo simulation. And so what we're going to do is just try to simulate those market variables. We're going to determine what that exposure is. And so for each simulation, remember, we're going to do thousands or tens of thousands of these things. And what we do is that we pick that midpoint. So what did I say? You know, and I should have said this back here, and I didn't. Let me just go here. So what did I say with my dad? April and July. So what's the midpoint in there? I don't have a calendar in front of me. So whatever that midpoint is, what's going to happen is that at some point, maybe at the midpoint, after a month and a half, my dad has 2 little cherry buds there, right? And so I look at Dad and I'm like, look, dude, there's no way this is producing 50. And I say, you need to post me some collateral. I say, you know what, Dad, I love your Cadillac up there. Post your Cadillac as collateral, which of course has way more value than the cherry the cherry tomatoes, but you get the sense of, let me just go back here again, margin posting, over margining, and all that kind of good stuff. So you see how the silly example with my dad really has lots and lots of good applications. So we need to worry about that midpoint. I failed to say that a little bit earlier, and we're going to calculate what is that exposure, because that's when we're at the highest level of risk. And then we just take the present value of that exposure. Well, there we do it right there at the bottom, time one minus that recovery rate. So there's an example there, 50 million times 1 minus 30% recovery. We get that 30%. We get 35 million down there, present value. What about if we post collateral, go back to my example just a few seconds ago of my dad's Cadillac, even though he didn't drive a Cadillac, and my Pink Panther Diamond from before, and just a bunch of Treasury securities. So we have collateral. And so look down at the bottom. I mean, the equation stays the same, but what we need to do is we need to make that exposure adjustment. So we go to that midpoint again, and we go ahead and figure out exactly what the value of the collateral is, what the value of the transaction is, and then we take the present value over that time period. And then I need to introduce this new concept here, this cure period. A lot of people call it the margin period of risk. It's usually 10 or 15 or 20 or 25 days. And so it's just really the time before default in which there's no additional collateral posted or returned. So you have the difference between, those two rates. I mean, don't tell your finance professors I said this, but, it's kind of like the basis in a futures contract. So just remember it. It seems like this. And here's a good illustration. So the last collateral posted, and then maybe we're going to have default over here on that far right orange box, and there's that cure period. And so there's nothing really interesting. And let me go back here real quick. There's nothing really interesting about 10 or 15 or 20 or 25 days, but clearly from an historical perspective, that this is probably the most efficient. I'm sure there's somebody out there that did some kind of a study that said the optimal cure period is 10 days or 20 days for each of these contracts. I would have no idea what the cure period is for my dad's tomato plant, but I might have a better idea what it would be for if I'm using Treasury securities as collateral on a synthetic collateralized debt obligation. 4 examples here about cure periods, and these are taken right out of the reading. And so look up at scenario 1 here. Value of transaction $50 million, and 20 days earlier it was at 45 million. So 20 days ago, the bank, now look, this is two-way, zero threshold collateral agreement. So we're the bank. Let's just pretend we're the bank. So we receive collateral worth 45 million, but now the transaction goes up to 50 million. So our exposure is the difference between those two. That's that $5 million. Suppose it goes in the other way, right? So 20 days ago, we received $55 million worth of collateral, and the value of the transaction is just $50 million today. Well, then we're not exposed, right? Because the collateral value exceeds the value of the transaction. Think of Cadillac versus tomato plants, or the Pink Panther Diamond versus a collateralized debt obligation. Now let's look at the other side of the transaction. Suppose that the value is a minus 50, right? So we owe this on this side. And then 20 days ago, we went ahead and posted 45 million. And so now that's less than, right? So minus 50 million is less than a minus 45. So the exposure is just 0. And then finally, scenario 4, we just flip this. And so our exposure is 5 million. So this is like, that is the basis, right? Boy, I don't want to say think of it as intrinsic value, but it's okay. Think of it as the basis, intrinsic value. It's either going to be positive or 0. Now, we've talked a lot about credit spreads. So we'll take the historical and the traditional idea that let's just look at a bond. So we have a bond here that is, let's say it's B rated, and it has a yield of, let's say, 10%. And the Treasury yield is 5%. So there's the spread of 5%. But then remember that we don't have to calculate the spread going back to the premium over the Treasury or the risk-free yield. We could do it on some kind of a benchmark. We could do it on whatever we wanted to do, right? We can compare ourselves to whatever we want, whatever is appropriate for this particular derivative contract. So that credit spread, boy, do you even need me to read that? Reflects the extra yield. Yeah, we know all about that stuff. But let's go down and read the bottom blue box there. This is important. With this counterparty risk that we're talking about here, they are essential to try to determine not just the cost of those derivative securities, but also trying to value any kind of future cash flows, especially as they relate to, maybe a swap contract. All right, we've done lots of probability of defaults in recent chapters. So let's go ahead and figure out what's going to happen here. So look at on the left-hand side, what do we need? We need to estimate the credit spread. So we can do this a number of different ways. We can go back, well, this is just what I was talking about here. We could do it against the Treasury. We could do it against the benchmark. We could do it against whatever we want. But we probably don't have an entire yield curve. Whether it's the par yield curve, whether it's the spot yield curve, whether it's the swap yield curve, whatever it is, we probably don't have every single point along that line. So we'll go ahead and interpolate. We'll go ahead and do some bootstrapping. I mean, there are a lot of different ways for us to do that. So once we get all that stuff and we find the counterparty's credit spread, then we're going to compute the hazard rate. We did hazard rates in a chapter or two ago, so this should be okay. So all we're going to do is we're going to put that spread in the numerator and then divide by 1 minus the recovery rate. Now, I found it interesting that in this particular chapter, the notation EXP is used, but in the previous chapter, the little italicized E raised to the exponent was used, but of course they mean the same thing. So all we're going to do is take that e to the x function on our calculator. Remember, that's Euler's number. We've been through this. And notice what we're doing. We're raising it to the S sub ti, which is the spread over some time period. So what is the spread? Now we'll do it in basis points, but let's put it in decimals. So it's very much like an interest rate. It's very much like the other things that we did in previous chapters times time. So I'm going to go ahead and repeat what I said in a previous chapter. Maybe you guys remember this, that don't tell your finance professors, but this is very similar to computing a present value. So that's pretty much what we're doing. But of course, in this case, since we have spreads up in that numerator, we need to divide by 1 minus the recovery rate. So that is the probability of not defaulting. So if you have the probability of not defaulting here and the probability of not defaulting here, and these are time periods, if you take the difference between those two, well, then you get the incremental risk of default over that interval from time period 1 to 2 or time period 500 to 501. You probably won't do it into the 500s. All right, so let's look at a quick example here. Corporate bond, 5-year maturity, recovery rate 40%. Using interpolation, all right, well, that helps us out so that we don't have to get out an Excel spreadsheet and do all this stuff for ourselves, or Monte Carlo simulation, or any of those time-consuming and computer-consuming transactions. All right, 100 basis points, 200 basis points. Calculate the risk-neutral probability of defaulting in year 2. So we're just going to use that equation that we did before. And so look down under that third equal sign. So what are we doing on the far right? There, the far right is 2 periods. There on the far left is 1 period. So you should be able to do the math there pretty quickly. So you got 98 minus 93. So there you go, about 5%. How about these credit risk mitigants? This is what I was saying really early in this recording. We're going to do a lot of netting. What did I say? If I owed you 10 million and you owed me 5 million, I forget what numbers that I used at the beginning of this slide deck. But of course, we're going to go ahead and net our cash flows. And of course, you think about this. This is why I gave the example of my dad being a farmer. If we've got tomatoes and potatoes and carrots and lettuce and cucumbers and cauliflower and all that kind of stuff. So we have all of these transactions. We need somebody to keep track of it. So the netting really is we're paying someone to keep track of all of our stuff. Think of it as the statistician in a basketball game where you have to keep track of assists and attempts and foul shots and fouls and technical fouls and all sorts of crazy stuff. Collateral, so there we go. Marketable securities. This is what I was saying with treasuries. Those are probably the most common. But you could use my dad's Cadillac if you wanted to, assuming you could get the blue book value of it, or you could use the Pink Panther diamond. And again, if you use the Pink Panther, and by the way, for those of you who've never seen a Steve Martin Pink Panther movie or a Peter Sellers Pink Panther movie, I would just stop the video right now and go watch the movie. That's a joke. I want you to keep studying and focus on here. But before you go to bed tonight, go ahead and flick it on for 10 minutes. I promise you that you'll laugh. All right, and then over on the far right, downgrade trigger. So that's self-explanatory. All right, here's this really cool idea of default correlation. Of course, sometimes that a bond defaults and that's the end of the story. But sometimes a bond defaults and then that default on that particular bond increases the probability that another kind of bond is going to default. So this is the idea of a correlation coefficient between and among bonds and loans and derivative securities. So why do they exist? This is probably a good exam question. Think about a multiple choice question where answer A is industry similarity, B is economic conditions, 3 is credit contagion, and 4 is stock market similarities or something like that. So in the question stem, GARP could give you, hey, you know what, or all of these bonds are located in the southern portion of Iceland, and et cetera, et cetera. Oh, of course, yeah, there's going to be default correlation if we have, well, let me just say something silly. If we have an ice storm in Iceland that causes a shutdown in the economy. Economic conditions, credit contagion. I learned about contagion. The first time I ever heard this word was in graduate school, and my professor was talking about the Argentinian default on its bonds and what that meant. And he used the word contagion. And for some reason, I immediately knew what he meant. It's contagious, chain reaction. Go ahead and get out your phones. Take a picture of this slide. This is super, super important. So how can we estimate default correlations? We can do it and we've had conversations about reduced form models. We've had conversations about structural models in the past. So take a picture of this and just go ahead and memorize everything inside of this matrix. Here are the exam questions. There will be a question that says something like, hey, suppose we use this structural model and we're given an assets and some bonds and some equity over here. And maybe you have to think about this in terms of the equity of a balance sheet as a call option on the assets of the business. Those were those structural models over there. So we're doing a structural model. What's the advantage? Well, hey, there's Merton, right? This is Merton based on Black-Scholes Merton option pricing model. Computationally intensive. I'm not really sure I agree with all that, but that's what we're told in this reading. More complex. I'm not sure I agree with that. But anyway, that's what we're told. So take a picture of this and memorize all these cross sections, because there are probably 6 or 8 really good exam questions inside of that table. So let's go ahead and start with one of my favorite topics here, this Copula model. So Gaussian, what does that just mean? That just means we have a mean and a standard deviation, and that's sufficient to describe the distribution. So calculate the probability of default. And then we're going to use this one-factor Copula model. So look down there at the bottom. This is super cool stuff. I feel like I gave you these things in a previous recording. So we have probability of default for 2 different companies. What do we want to know? We want to know that correlation coefficient between those 2. So how do we compute this copula? What we do is we take those normal distributions, right? And from that we can get a marginal distribution, and we can lay those marginal distributions on top of each other to get a joint distribution. And what that joint distribution will tell us is how they're related. So that correlation coefficient that we learned way back is probably insufficient to handle all of the interactions and the interrelationships of all the stuff that goes on the left-hand tail. That's why we need the copula. Now, when you compute that Gaussian copula, you need, here, let me just go back here quickly. You need all this stuff. And what all this stuff means is that you need to know everything about company I and everything about company J, meaning things like board of directors, operating cash flow, dividend payout, share repurchases. You need to know all that stuff. So each one of those variables has its own unique kind of a distribution. So imagine all the distributions that are going in to the calculation of, and boy, is it obvious why you just can't calculate a regular old Pearson's correlation coefficient, because it would never capture all that stuff. Actually, I'm not even sure how to calculate a simple correlation with all that stuff going on. That's why you need the Copula model. So instead of doing all that extra stuff, how about if we say something like, you know what? What if, let me go back here. What if all that stuff is highly correlated to one factor? Maybe that one factor is the daily return in the stock market on that particular company I and that particular company J. Well, we can calculate a simple correlation coefficient between the returns on two stocks, but wouldn't it be even better if we computed a copula based on the returns of those two? So that's what we're doing here. Yeah, what we do is we transform those variables into an X variable. So the A, these are just correlations, and look at the F in there. That F is a common factor. Maybe it's stock returns, maybe it's inflation, maybe it's GDP, maybe it's the number of moon rocks that are floating in outer space. I mean, clearly that's not going to be the example, but one important factor. And then Z over there, that Z is how that particular factor impacts company I in this case. So think about what that Z is. That is almost like the beta of a share of stock. It's almost like a beta. Now, what we can do then is we can transform all that stuff that we just talked about into a default probability. So in blue and in red, this should look a little bit familiar from, here, let me do this real quickly here. Let me go right, here's Vasicek's formula that we did, a couple of chapters ago. So let's go, oops, I went one too far. So look up in the blue, what we can do is we can say, hey, let's go ahead and compute this default probability. Now, this is Q. It depends on a common factor. And the chapter really doesn't give you any kind of a good idea about what that common factor might be. But on the exam, I'm guessing that GARP might just say, hey, here's a common factor. But it might just say, here's a common factor, risk-free return or something like that. So we're going to go in and we're going to try to throw all those numbers in here. But what we can do to simplify life is that if we assume that all companies have that common correlation coefficient, in other words, they commonly respond to that factor. That's why I said something a little bit earlier about beta. Then you can substitute that common correlation coefficient in there. There it is, the sideways P or the rho. And of course, that sideways P or the rho is not just the regular old correlation coefficient from 100 years ago, but the Copula model. So let's do an example here. 1 year, 5% common factor affecting all companies. So there we go, common factor. We don't know what it is. 1.2. There's the Copula correlation, 0.2. Calculate the default probability. Now, I'm not going to take you through this because I did this in a previous recording, but you can do the math in there, right? Just substitute. And then we need that inverse function, and then we need the cumulative function. So what I'm going to do is I'm just going to point you here to the very end of our slide deck. So go ahead and get your camera out. Did I tell you to take a picture of this the other day? Take a picture of this, have this in your back pocket. So what I will do is I will let you, where did I go back? Is this where I am? Yeah, there's, all right. So you'll need to look up the 0.05, look up those numbers, and you should get 0934 as the default probability using the one factor Gaussian Copula model. which is exactly what one of these learning objectives tell us to. All right, so now what we can do is we can go back to that Valuation formula that is going to give us the percentage of losses on a large portfolio, excuse me, that are larger than whatever that value is. So what we can do is we can use the Gaussian stuff. We can go ahead and combine that with Valuation to move on with our lives to do this credit value at risk. All right, so let me go through these diamond points just really quickly. So we know about credit value at risk. We did this before. We're going to use the Gaussian Copula, right? Considering those correlated default things, we transform those default probabilities into the standard normal. So we did all that before. And there's the parameter. So there's the Valuation formula. You know, I'm guessing you guys are going to have to memorize, you know, all this stuff here. Let's go ahead and do this credit value at risk. So we need a couple of other variables here. Look down at the bottom, the size of the portfolio and the recovery rate. So let's go ahead and do an example here. 1 year probability of default, 1%. Confidence level, look at that, 99.9. That's almost equal to the 5 nines. You guys heard of the 5 nines, 99.999. So there's our Copula point 2, size of the portfolio 12.5, recovery rate 60. So calculate the credit value at risk doing all this stuff. So once again, we're going to go ahead and get that value there, right? So the V is 0.1446. So all we're going to do is multiply that by the 12.5, which is our loan. There's the 40% one minus the 60%. So there we go. So what was our portfolio there? It was 12.5 million. So our portfolio credit value at risk is, what is that? 723,000. So notice that we have the 01, the 999. We have all that in red and blue. So take your phone out. You have a picture of that. I'll just go here because it's right there. So there you go. Did you guys miss the picture or did you have to pause the video? So just look on this table and you should be fine, right? So that's probably a really good exam question. If I were making up the exam, this is the one I would do since we've been talking about credit value at risk for multiple chapters. All right, remember this CreditMetrics approach that we did in a previous slide deck and a previous chapter. So what are we doing here? Trying to figure out what that probability distribution of all the credit losses by using this Monte Carlo simulation. So you could probably guess this chronology because we've talked about Monte Carlo before. So what we do is we say something like, you know what, suppose that this particular derivative or this particular loan, the credit rating changes, somehow something changes in there. So let's just run those simulations over and over and over again and then reevaluate those outstanding contracts, put together a distribution curve, and then you can compute the credit value at risk at the end. Advantages, yeah, range of credit events, right? Challenges, right? We need to have hundreds of hours of computer time. And that takes us through those learning objectives. Boy, I wish I could tell you to go look at some of the problems at the end of this chapter, but there are none. And so go ahead and look through the chapter. There's some really good problems in there. We've done some here as well. My focus, my suggestion is to focus on the second one, CVAs and DVAs. Boy, that's probably 1, maybe 2 questions on the exam. And then you know about credit spreads and then apply those to default correlations and the Copula model. So that should be sufficient for you to prepare you for the exam. So hey, thanks for watching. Have a great day and good luck studying.